Hello everyone, welcome to the channel where as always we provide you with that financial education and information. And in today's video we're going to talk about good cash value life insurance versus bad cash value life insurance. And when I say bad cash value life insurance, I'm talking about bad in comparison to the good one, the one that's set up for your maximum benefit as a client where you can use it for infinite banking. That's what I'm talking about. But in the long run, even the one that's not structured like that is going to be better for you in the long run compared to your bank or perhaps your 401k or IRA. Now, before I dive into everything, I just want to mention something about what Dave Ramsey has to say. He has a lot of negative things to say about cash value life insurance, and he says infinite banking is a scam, but he doesn't know what he doesn't know. What you have to understand is that Dave Ramsey is not a life insurance professional. So he knows just about as much as what the general public know when it comes to that, right? So when he talks a lot of things about infinite banking that's not correct, he just doesn't know what he doesn't know. He's great at telling people how to manage their money and how to not get themselves in debt, in trouble. And for some people, that's great advice, right? How not to get themselves in trouble. But if you're a wealth builder, he's not talking to you. Now, if you really want to know how a cash value life insurance could be structured for infinite banking, then you need to speak with a life insurance professional that understand structuring a policy specifically for that. All right. So let's talk about what some of the things that Dave Ramsey's talking about, but it's not really infinite banking, but it's a cash value life insurance policy that's not structured for your maximum benefits, where it's structured where the agent gets a lot of commission and you don't really see a lot of your value in the first couple of years. So let's talk about that. All right. So when it comes to life insurance or cash value life insurance, when you pay your premium, right? When you pay that monthly premium or quarterly or yearly, however you choose to pay it, when you pay that, you're going to have two buckets, right? You're going to have a bucket where money goes to the death benefit. So money goes to paying for the death benefit, right? And then you got to have a separate bucket where money goes to building cash value. All right, so it's two buckets. You're going to be a cash value and your death benefit. So a policy that's structured heavily on the death benefit is not going to grow well. All right, and you're not going to see a lot of back from it because less money is going towards a cash value where the money is growing and more is going to pay for the cost of insurance. So that's the type of policy that Dave Ramsey is talking about. And a typical policy like that, that most companies advertise, that most agents advertise, most of the money is going towards your death benefit. In some cases, 100% of it at the beginning is going to death benefit. So when you look at an illustration, which is a report, when you ask for a life insurance quote, a permanent life insurance quote that has cash value, it has an illustration where they show what the guarantees are and they show what is expected. So if you look at the first 2 years of those type of illustration, you're putting in money and you're not seeing any cash value. So for example, let's say you have a policy where you're putting in $25,000 per year, right? Because you want some cash value, you want it to grow. But the first couple years in the cash value column, CV column, you have 0%. Year one and year two, you might see 0%. So after year two and you put in 50,000, you're saying, how is it after 2 years I do not see any cash value? It doesn't start building cash value. And the agent will tell you that it takes a while to build cash value. Well, the reason why it takes a while to build cash value is because those first couple of years, you're paying for the agent commission and the administrative fees and all that. Your money is just going strictly to that. So not until the third year, sometimes the fourth year, you start seeing some cash value, and then it takes like 10, 11, 12 years for you to actually catch up, right? A long time. So that type of policy is not structured for your particular benefit, right? At the beginning, you should see your cash value working for you, all right? So that same 25,000 in a policy designed for infinite banking, where less is going towards the cost of insurance. You're getting a less of a death benefit, and the cost of insurance is going to be less, right? And then more of the money is going to go towards your cash value, because in this case, you're structuring it for the growth of the policy. You want your money grow. You don't want your money dumping in mostly the cost of insurance and eating up a lot of your cash value and paying for high agent commission and administrative fees and all that. So when you structure it correctly for growth, most of your money is going towards your cash value and less towards agent commission. So the agent will make a lot less on the same amount of money you're putting in. So that same 25,000 that you put in year one, you might see $19,000 in cash value. I'm just throwing out an example here, okay? Depending on how your policy is structured, it might be less or it might be a little more, depending on how it's structured. But you're going to immediately see in year one cash value available for you to borrow against, because you're structuring for that. That means the agent is getting a lot less in commission. But this is how I would want it done for me, so that's what I'm doing for my clients. Less commission, because this is what's better for the customer that wants to grow their money. Because eventually with growth, your death benefit will catch up and increase anyway. So I want to structure a policy where the customer, the client, could utilize their policy in the first year, in the second year, and their cash values catching up in maybe year 4 or 5 as opposed to year 10, 11, or 12. You know what I'm saying? And it's growing faster and rapidly and compounding, and then you have more cash value, more money to leverage against. And as that grow, your death benefit will grow. So when that cash value catches up to your death benefit, it's going to also push your death benefit up. All right? So this is the way a policy designed for infinite banking is structured, where you can utilize the cash value immediately, because the goal here is to grow your cash value and have it available as soon as possible and make it grow as fast as possible, so you can leverage more of it and leverage more of it. The death benefit is just the icing on the cake here, right? But the main goal here is growth. And that's how you want to structure a policy designed for infinite banking. Again, in the bucket, it's going to be more cash value and less towards the death benefit. Whereas a policy that's not designed for infinite banking is going to have more money going towards the death benefit, and the cash value is growing less. Okay, I hope that makes sense to you guys. As always, if you have questions, please leave it in the comments. If you find the information valuable, make sure you like the video. It doesn't cost a like, and share it with someone that could actually benefit from it, right? And if you haven't already done so, please be sure to subscribe to the channel. I drop a video at least twice a week. And hit the notification bell, so whenever that video is dropped, you're one of the first to be notified about it. All right? If you have questions, please leave it in the comments. I'll also leave a link if you want to have a free consultation with me, where I could actually look at your particular situation and see if you are ready to set up infinite banking for you, and see if you qualify for that and all that. So I'll leave that link for you to set up a free consultation, and ways for you to connect with me as well. Until next time, I'll see you guys soon.